Hey students, welcome to week 9. This week's learning objectives for bus222 accounting. Excuse me, I'm fighting a cold here. We're going to define the partnership form of business, and we're going to look at some of its principal characteristics as well. It's kind of interesting. This is a very popular form of business entity, and we'll talk more about it, but it's a pretty popular one, so it's good to know about it. We're going to look at in a partnership form where you have partners, so they each have investments of cash and other assets that they bring to the table. So we're going to look at that. And then we're going to look at computing and recording income losses that partners go through in the course of a business and how you capture that from an accounting perspective. We're going to look at what they call stated ratios, capital balance ratios, and then a little bit about salaries and interest. Make sure you read the entirety of chapter 12 to go through all the detail. I'm just going to hit the highlights here. So a partnership is defined as it's an association of two or more people to carry on as co-owners of a business. Usually this is driven by some sort of an agreement. If you're familiar with any kind of partnership, there's some sort of a driving agreement behind it. And partnerships are treated as separate business and tax entities. They have their own set of records, financial statements, etc. Now, there is no economic separation, though, between a partnership and its owners. So if the partnership as a company does well, then the owners do well. So the success of partnership or the failure of partnership spills over into the success or failure of the owner's finances, too. Different forms of partnerships. There's S-corps, limited liabilities, and special purpose entities. I am part of a company that is a limited liability. There are 4 partners. I'm not one of them, but there are 4 partners, and they have a partnership agreement. One of those partners is, in fact, president of our company. It's an LLC. Excuse me. So partnerships are a voluntary thing where people get together. Oftentimes people have some things in common with each other. They know each other. They might even be friends. In the case of the partnership that our company belongs to was formed by 3 brothers and a brother-in-law. So, or actually, I guess maybe a cousin-in-law. Anyways, they're basically family members. It's voluntary, but it's legally responsible for partners' actions within the scope of the business. So this is a voluntary association, but once you're into it, you are kind of like joined at the arms with each other. There's a partnership agreement that drives how things work. The business agreement, the partnership agreement can be very simple, it can be very complex, and you can see listed there some of these elements that would be in a typical partnership agreement. Partnerships can have a limited life, may only be for a certain time period, and then it's dissolved. Partnership agreements determine, how new partners entered, how the company is dissolved, how people leave. And each partner is an agent of the partnership. So if one of the partners says we're going to do this and they legally bind the partnership to a certain direction, then the whole partnership is bound to that particular direction. So it's called mutual agency or shared agency. Excuse me. Each partner has personal unlimited liability for the debts of the partnership. Now in a limited liability corporation, that liability is limited. It's not necessarily unlimited, but unless otherwise specified, if the assets of the business are not enough to pay for debts and liabilities, creditors can go after both not just the partnership's assets and cash, but also each partner. So make sure if you do get involved in the partnership someplace, make sure you understand what your liability is. And participation in partnership income is a topic as well. Each partner has the right to share in the partnership's income and the responsibility to share in its losses as well. In the LLC that I'm involved with, the partners do very well. The business does well, and they all share. Yeah, they share the liability, but they also share the income. They share the profit, actually. You can see some advantages and disadvantages. I'll point out a couple. Partnerships are really easy to put together. Other than some lawyer costs, doesn't cost a lot to do, at least in the state of Michigan. And generally speaking, the life of a partnership is limited unless there's some sort of, wording that allows it to keep going on into perpetuity. There's a lot of pooling of assets and talents. That's usually what pulls people together into a partnership. Somebody has money, somebody has talent, and they do well together. They get along well. It is more difficult for a partnership to raise capital than it is for a corporation. So keep that in mind. If you need to raise capital as part of a partnership, it may not happen. You may have to go out and get a line of credit, borrow some money on your own personal wealth and that sort of thing. From an accounting perspective, the owner's equity in a partnership is called partner's equity, not owner's equity, so it's partner's equity. And it's necessary to keep track of the different withdrawals and contributions by each partner. In fact, if you look at our financial statements, I could show you the partners, individual 4 different partners, what they put in and what they take out. So it's all kept separate. This would be an example of how, in a sole proprietorship, how you might keep track of capital deposits and withdrawals, but in a partnership, it's actually done by the person's name. Whoops. Each partner invests cash or other assets into the partnership according to the agreement. Not everybody may not give the same amount, and we're going to talk about that in a second. So distribution of income and loss is often done on a on a ratio basis, which we'll talk about in a moment about. But a partnership's income and loss can be distributed according to whatever method the partner specified in the agreement. I can caution you, if you get into an agreement like this, make sure it's specific about who's going to share the income, or how income is going to be distributed, and how losses will be distributed as well. And a partnership normally has 3 components. It's the return to the partners for the use of their own capital, compensation for services. So for example, one of the partners in the company that I work for, like I said, is actually president of the company. So he gets a salary for that. The other 3 partners don't get that salary. He gets it because this is his full-time job. And then there's other income that normally comes into a partnership. It might be from the sale of a business, sale of assets, and that sort of thing. So there's a couple different ratios that help distribute income and loss. One of them is called a stated ratio. Real simple, just it's an explicit ratio of between the partners, the 2 or 3 or 4 or 6 partners, or whatever you have, who gets what. So if each partner is making an equal contribution to the firm, each can assume the same share of income and loss. It may not be true, but it should be explicitly stated. So an equal contribution, that's this point, equal contribution doesn't necessarily mean an equal capital investment. One partner may be devoting more time, and somebody else might be devoting more capital. There's this capital balance ratio approach. Whoever puts in the most gets the most back. Kind of the easiest way to remember that. And then let's talk about dissolution of a partnership, how a partnership is dissolved. Usually whenever there's a change in the original association of partners. So for example, in the business that I'm in, there was an original owner who had partners. It was him and one other person. He sold the business, and so the partnership was dissolved. And then 4 other people purchased the business, and so a new partnership was formed. Now, internally in the company, as employees, we didn't necessarily know the difference. I mean, I did because I was involved with it, but so everything changed. But the one LLC dissolved, and the other one, partnership LLC, was formed. So oftentimes, dissolving of a partnership happens when you let a new partner in. You kind of like stop, reform, and just start again. Again, partnerships are easy to form. And then liquidation of a partnership is the process of selling off the assets to cover liabilities and outstanding bills and that sort of thing. And it's a subset of dissolution of dissolving the company. Okay, so that's it for this week. And remember to read chapter 12. Reach out to me with questions. And remember, God is on his throne. He's always been there, and he's always going to be. Have a great week.